Picture this. You're in a city made of data. It's always nighttime, and there's this constant rain of information. The headlines, they flash like broken neon signs in the fog, every single one screaming a warning. And in the city, fear is the only currency that matters. And clarity, well, clarity is a back alley deal. Our job right now is to cut straight through all that noise and find the one thing that counts, the signal. And man, is it loud out there. Out on those digital streets, you've got this army of so-called experts, and they are shouting from every rooftop. They're telling you the old rules just don't apply anymore, that your map is useless. They're whispering that this crisis, this war, this very moment, it's completely different from all the others. Then you've got the big players, the major networks, and they're blasting their message from every single screen. Their story is simple, it's emotional, and it is designed to do one thing: make you panic. It's like a siren's call to just sell everything, react on impulse, and get out before it's too late. And all of this just hammers home that feeling of immediate danger. Every single alert, every banner on the screen, every breaking news update paints this picture of a total collapse about to happen. You, the investor, feel like you're standing at a crossroads where every single road sign is just pointing towards disaster. But what if they're all pointing the wrong way? Okay, enough of that. To solve this case, we can't listen to the chatter on the streets. No, we need to go back to the archives, pull the old, dusty case files, because history has left us a blueprint, a pattern that's been hiding in plain sight this whole time, and it tells a very, very different story. Just take a look at the evidence file from the last 17 years. You had the dread after the financial crisis, debt ceiling showdowns, market crashes in China, a global pandemic, and wars in Ukraine and Iran. I mean, every single one of these was sold to us as a run-for-the-hills moment. And yet, the S&P 500 just keeps climbing. All those world-ending crises, in the grand scheme of things, they're just little blips on the radar. And here is the sheer power of that long-term signal. Since the absolute bottom in 2009, through all of that chaos we just saw, the market has returned 940%. Just let that sink in for a second. All the noise, all the fear, all the panic, it was nothing but a distraction from this incredible, relentless upward climb. And the math on this is actually pretty simple, but it's incredibly powerful. The data shows that your average bull market, that's the long game, it lasts for about 5 years and gives you returns of around 180%. The average bear market, the short shock, it's usually over in about a year and a half with a 35% drop. The key takeaway here is that the good times last longer and are way more powerful than the bad times. Playing the long game is like playing with a stacked deck in your favor. So what does this actually mean for your odds of success? Well, if you're a day trader trying to guess the market's every little move, you're basically flipping a coin. You've got a 54% chance of being right. Now, if you stretch that out to swing trading over a year, your odds get better, up to 75%. But look what happens when you just commit to a 10-year horizon. Your odds of success skyrocket to 95%. You go from a gambler's bet to what is pretty much a statistical certainty. The secret isn't being smarter than everyone else, it's just being more patient. Okay, let's pivot the investigation. Right now, all the fear is laser-focused on one thing: inflation. The headlines, they're all blaming oil, supply chains, geopolitical stuff, but that's just the prime suspect they want you to see. The real culprit, it's been hiding in plain sight this whole time. So the story they're spinning for you is that rising oil prices are the big bad villain, that they're going to trigger a recession and bring the market crashing down. And it's a compelling story for sure, but it's a total distraction. It's the false lead in this case, designed to keep you from looking at the real source of the crime. But then we get a break in the case, a clue that cracks this thing wide open, from the legendary economist Milton Friedman. This isn't just his opinion, it's a fundamental law of economics. He's telling us that oil prices don't cause inflation. Unions don't cause inflation. The only thing that causes sustained inflation is the expansion of the money supply. So what is he really saying here? It's actually pretty simple. When a government creates new money way faster than the economy is actually growing and producing things, every single dollar you have becomes worth a little bit less. That's inflation. It's not caused by some sheik in the desert. As Friedman famously said, it's made in Washington. It is a policy decision, not some random market event. Oil prices go up, oil prices go down. But the money printer, well, that's a different story altogether. All right, so we've found the signal. We've unmasked the real culprit behind all this economic anxiety. The case is pretty much cracked. So now what? Now we give you the playbook. We give you the tools you need to navigate this chaotic city and actually turn it all to your advantage. And this right here is the golden rule. Stop trying to guess when the bottom will hit. Stop trying to predict the next crazy headline. This game isn't about having a crystal ball. It's about having a plan, a system that works no matter what the market decides to throw at you. It's all about preparing, not predicting. And this is that system. It's called dollar cost averaging, or DCA. The playbook is simple. 1. Commit to a fixed amount of money you can invest. 2. Invest that amount at regular intervals, say every month, no matter what the market is doing. 3. Here's the magic. When prices fall, your fixed amount automatically buys you more shares. So 4, when the market inevitably recovers, your average cost per share is lower and your gains get amplified. You're literally using other people's panic as your opportunity. Look, if you think I'm just making this up, listen to one of the greatest investors of all time, Peter Lynch. The biggest risk you face isn't being in the market during a correction. The biggest risk is sitting on the sidelines, paralyzed by fear, trying to perfectly time when to get back in. History and all the data show that trying to time the market is a sucker's bet. All right, let's wrap this case up. With everything we've uncovered, what is the specific opportunity on the table for us right now? It all comes down to understanding the price you're paying, not just for today, but for the next decade. And this final piece of evidence, this is the smoking gun. The S&P 500 is at the exact same price level it was 5 months ago, so nothing's changed, right? Wrong. The forward price-to-earnings ratio, which is just a fancy way of saying how expensive the market is, has dropped from a pretty risky 26 down to a much more attractive 20. What this means is that the underlying businesses are now cheaper. You are getting a better deal today for the exact same assets, which historically sets you up for much higher returns over the next 10 years. So, there it is. That's the case file. The fear, the headlines, the daily panic, that is all just temporary noise in this crazy city. But the relentless, upward trend of innovation and growth, the one that's powered by a sound, long-term strategy, that is the permanent signal. The only question left is, in 10 years, which one will you wish you had listened to?